Hi, I'm Byron Gangnes, Senior Research Fellow with UHERO. I want to give you a quick update on some of the issues that will affect Hawaii's outlook over the next several years. I'm going to focus in particular on the external environment that we face and in particular conditions in the U.S. And there I want to look at two things. One is the ongoing battle against inflation by the Federal Reserve and how that might play out. And then I want to talk about the debt ceiling struggle that at the time I'm talking, at least, is still ongoing. Let me turn to Federal Reserve first. As you know, the U.S. Federal Reserve has been raising interest rates rapidly over the past year in an attempt to fight inflation. Inflation picked up sharply during the pandemic and its aftermath, first because of supply constraints, and then second because of very strong demand. During the pandemic, that demand was primarily for goods, all of our Amazon purchases, excuse me. And then during the recovery, as we began to travel and eat out, the demand for services went up strongly. And so those pushed inflation up. In this graph, what I'm showing you are two measures of inflation. One is the Consumer Price Index that you hear about all the time. And the other is the Personal Consumption Expenditure Deflator, or PCE, measure of inflation that the Fed focuses more on. But by either measure, you can see that inflation rose to really very high levels last summer, but has also come down significantly since then. That's good news. However, by both measures, inflation remains much higher than what the Fed would like to see in the long run, which is about 2% inflation over time. So the Fed certainly would say that its battle against inflation is not yet over. Now, the Fed fights inflation by raising interest rates. It raises interest rates to discourage borrowing and spending by households and firms. And we've seen that in some parts of the economy quite dramatically. So home resales in Hawaii and the mainland have fallen precipitously since interest rates went up last year. Housing affordability has gone down, which is a big concern here as well. Are we seeing evidence of the interest rate effects on the economy looking at the broader economy? And the answer there is yes, in some areas and not necessarily in others. And so in particular, manufacturing has fallen sharply since the interest rate increases occurred. This picture shows what's called the Purchasing Managers Index measure, which shows the difference between how many firms in the manufacturing sector are seeing increased activity compared to those seeing declining activity. And there has been a net decline in activity for the last half year. And so interest rate increases have pushed the manufacturing economy already into recession. In the broader economy, there are still areas of considerable strength. And of course, the one that we know is very strong is the labor market. And so the right graph shows you the unemployment rate for the U.S., and you can see that unemployment is at a very low level. In fact, this is the lowest levels we've seen in a half century. And so there's a lot of strength yet in the labor market. The Fed worries about this because tight labor markets mean wages tend to rise rapidly, and that can get passed into inflation. Even in the labor market, there are some promising signs. We are seeing slower growth of jobs on a monthly basis than we've seen in the past couple of years, and we are seeing less excess demand for jobs as well. But still, the labor market is quite tight. And so the question is the Fed seeing enough signs of slowing that it will be able to hold the line on interest rate increases and then begin to bring them down, hopefully, as this year and next year proceed? Or is it going to maybe even have to raise interest rates further because it just doesn't see enough action on slowing the economy and inflation? We think that the outcome of all of this will be a mild recession for the American economy beginning later this year and running into 2024. Let me turn to, hang on, I'm going to do something else first. So let me go back to just me. I want to talk about the debt ceiling before I go back to the local economy. At the time I'm recording this, the debt ceiling situation is still ongoing. Biden and House Speaker McCarthy have met, but both sides remain far apart in terms of what kind of spending cuts they will agree to in order to raise the debt ceiling. And so hopefully by the time you are watching this, this will all have been resolved. But at this point, there are two concerns. One is that if the federal government runs out of money, which it may do as early as June 1, that they will have to shut down the government temporarily. And that means that employees will temporarily not get paid, and perhaps even Social Security recipients will not get their checks. And even if they get made whole eventually, that will, of course, be very costly in the near term. The big concern this time around is the possibility that for the first time, the government might actually default on its debt. That is, fail to make payments on existing bonds that it's issued, borrowings that it's done in the past. If that were to happen, that would be very disruptive to the U.S. economy. It would likely cause a very severe U.S. recession, and that would have impacts here as well. Okay, let me go back to what I was going to show you and talk a little bit about the local economy as I finish up. One problem we face is that our visitor industry is more dependent on the U.S. economy than would normally be the case. And that's because the U.S. component of the visitor industry has recovered very rapidly and remains very, very strong, whereas international markets are lagging in recovery considerably. That means that the share of the total industry dependent on U.S. visitors is much higher than it is in normal circumstances. And so as the U.S. economy goes into recession later this year, that will pull down somewhat on the number of people who are going to travel here. That will pull down on the overall economy, even if the ongoing recovery of the international market softens that blow to some extent. So we'll see somewhat slower tourism. For the overall local economy, good news, job market's good. It's healthy. And even if we have a slowing that takes place, we don't expect unemployment to rise dramatically over the next couple of years. And then we have a particularly strong construction sector right now, partly because there are a number of very large federal construction projects that will be ongoing for a number of years. And so construction, relatively healthy labor markets going in, should help to keep us above water as we go into a period of softer economic performance over the next couple of years. So thanks very much. Aloha.